Upstart is a lending platform that uses artificial intelligence to make lending decisions. The company recently reported quarterly financial results that sent the stock price down by more than 10%. Investors are asking if this is a buying opportunity or if this is a stock they should avoid. I will evaluate the company's latest quarterly results and update my buy, hold, or sell rating on Upstart stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The company's management team said that their AI platform is performing exactly as designed, rapidly adapting to evolving macro signals while delivering strong results. And those macro signals could be things like the unemployment report, the inflation report, the GDP figures, and other macroeconomic data that's released by the United States government. Now, that number of data is decreasing now due to the government's shutdown, so that's making it more difficult for Upstart to use those signals to make these lending decisions. Of course, there are many inputs to this lending model, and I don't think Upstart will share all of those signals. That's part of its proprietary business assets. But the fact that the data is limited is a risk for Upstart in the loans that they're generating without all of the data that the model is used to incorporating in making these lending decisions. Still, in the most recently completed quarter, the company generated 428,000 loans or originated 428,000 loans, which is up 128% year over year. That reflects a 20.6% conversion rate, which is up from 16.3% in the same quarter last year. I've always said that the number of borrowers is never limited. There are always people willing to borrow money, and there will never be a shortage of people willing to borrow money. The question mark is, how many qualified people are there to borrow money, or how many people can you lend money to where you can expect a reasonable amount of those people will pay back the loans that they borrow? That's the big question mark. And to solve that problem, Upstart is using artificial intelligence for their due diligence for borrower applications to determine if they should get approved for a loan or not, and if they should get approved, what interest rate should they be charged for the loan that they're looking for. If Upstart longer term can prove that this model is relatively as effective as legacy and traditional models, then Upstart has a huge upside in front. That's because over 90% of the loans that it originates are fully automated without needing a human in the process. And that helps facilitate a smoother transaction at significantly lower cost. And if you're a borrower and you're comparing places to go to borrow money, of course you would prefer the platform that's fully automated, where you don't need to constantly communicate with a loan originator, always asking you for more and more documents and asking you questions, sending you documents to sign and send them back, and then asking you more questions, asking you for more information. Send me your pay stub, send me your tax return, send me this, send me that, send me your blood type, all of these other things that lenders typically ask in a holistically annoying process if you've ever been a part of it. And this aims to improve that process meaningfully. They don't need to be better than the traditional process. They really don't. They just need to be close. As long as they're close, the cost savings and the convenience advantage will outweigh the legacy methods, and they'll gain significant market share because of that fact. Revenue jumped by 71% to $277 million, and income from operations jumped to $23.7 million, up from negative $45 million in the same quarter last year. Looking ahead, the company is expecting slight improvement. Total revenue of $288 million would be up $11 million from the previous quarter, but that would be a significant improvement from the same quarter last year. Net income of $17 million would be down from the current quarter net income of $31.8 million. And I think that's one of the reasons why investors were disappointed in the company's quarterly financial results. Investors were asking, wait a minute, if your revenue is increasing from the previous quarter by $11 million, How come your net income is falling by a significant amount from the previous quarter? Additionally, the adjusted EBITDA expectations of approximately 63 million would be down from the adjusted EBITDA of 71 million in the current quarter. So regardless of the profit metric you're considering, the upcoming quarter is expected to be lower. Now, some of the categories the company is spending money on, I like to see spending in these categories. They're spending money on research and development. They're spending money on sales and marketing. And these are categories I appreciate when companies spend. I don't like when companies spend money in general and administrative expenses. These are corporate expenses. These are expenses on things like a corporate jet or a remodel of the corporate headquarters or an expansion of the corporate headquarters or increasing benefits for the management team, maybe for the Christmas party, etc., etc. Things like that are grouped into that general and administrative expense line item, and I don't like to see rising costs in that category. If anything, I like to see companies keeping those costs flat or decreasing those costs, especially as a percentage of revenue. As the company scales, I don't want to see that line item increase. Now, you do need a certain baseline amount, right? You need an accounting department, you need a legal department, you need marketing, you need board of directors and the payments for the board of directors. So you do need a baseline of cost in that category, but I like to see that baseline remain relatively flat as a company grows its revenue. Another sign that I'm not too thrilled about with the company is the loans held at fair value on the balance sheet increased meaningfully from December of 2024 to September of 2025. It increased by more than 50% from 806 million to 1.2 billion. I like to see this company operate as a platform, bringing together borrowers and lenders and taking fees on those transactions. I would prefer this company not become the lender itself, not holding on to the loans that it's originating on the balance sheet. It's an already risky business. And if they're also holding the loans on the balance sheet, it makes it that much riskier and it makes it that much more difficult for the business to scale because it will always need capital to fund those loans. Whereas if it's working primarily with third parties, just originating the loans and then third parties are owning those loans, it makes the business more capital light and allows bigger upside in the longer term. So I found this to be encouraging that the percentage of loans that were fully automated remained at 91% compared to the same time last year, even though the number of loans originated more than doubled from 188,000 to 428,000. Now, that's a more than doubling of the amount of loans originated, and yet the percentage of loans automated remained at 91%. I was concerned that as they originate more loans, there's going to be more cases that cannot be fully automated that need human intervention. And that's a concern because it indicates that the business is not as scalable as I originally thought. But that's not the case because they more than doubled the number of loans and they maintained that 91% automation rate. And that's a good sign. That's a signal that this business can scale while still generating these loans automatically. And so that was a positive signal for me as a longer term investor thinking about, I don't own Upstart stock, but I'm very interested in this company. And I wouldn't be surprised if I purchase this stock from my portfolio sometime soon. I'm very interested. I've been watching this company more closely in recent months. About a month and a half ago, I upgraded this stock to a buy on my stock recommendation list. And so I'm very interested. And following the earnings release, Upstart is now trading at a price to earnings, forward price to earnings of 26, near the lowest level this stock has traded for according to this valuation metric, going back all the way to early 2025. Save for a brief moment during the initial announcements of tariffs, the stock has traded for a more expensive valuation. So I will be reiterating, and I did reiterate my buy rating for Upstart stock following these earnings results. Of course, the big risk being that the AI model for making lending decisions is completely and significantly worse than the traditional lending methods, and the performance during a downturn leads to more defaults than originally expected. And so the model just becomes ineffective and lenders become uninterested in lending money where the loans are originated using this due diligence method. That's the big risk for Upstart stock investors. But there's huge upside as long as their AI model can be close to legacy methods because of that big cost and convenience advantage they retain. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.